Year-round House of Coffee gets millions of happy customers. Some go out of their way to get their larger cappuccino in the morning, or their coffee puff pastry for dessert. We've looked at holiday specialty drinks, but what about answering the question, which product will cover expenses and generate the most profit for House of Coffee? That's when unit contribution margin comes into play. Unit contribution margin compares each unit of sales revenue to its variable cost required to generate that 1 unit of sale. It's an important data point for businesses to know, and that is why you want to tackle this topic with House of Coffee's owner today. Most business owners will think the higher the margin, the better. This can sound greedy, but it's quite the opposite in fact. Higher margin doesn't only mean higher money in your pocket. For a successful business owner, higher margin also means there is more money to contribute toward fixed costs and provide a better customer service and products to its customers. Units of products or services with the highest unit contribution margin means that fewer units need to be sold in order to cover fixed costs. Knowing the unit contribution margin allows businesses to focus their sales efforts on the products or services with the highest contribution margin. Hello, certified professional. If you are enjoying this course, get accredited with CPE credits for watching it. Click the link in the show notes or visit cpeflow.com to access the full course ad-free and pass the final assessment quiz to officially earn your NASBA approved CPE credits and certificate of completion. Now, let's take a look at the formula. The unit contribution margin formula is sales price per unit minus variable cost per unit, which equals contribution margin per unit. Let's revisit our previous example from House of Coffee. As you can see in the table, if the sales price of one large cappuccino is $7 and the variable cost to make it is $3, then the contribution margin per unit is $4. How is this formula applicable to House of Coffee's 3 consumable products? Let's compare House of Coffee's products and their respective unit contribution margins to illustrate. As the numbers reveal, the large cappuccino has the highest unit contribution margin of the 3 products. The owner had revealed previously that House of Coffee has a $2,000 rent payment, and that's a fixed cost, and that we want to be able to cover. In order to cover that rent payment, only 500 large cappuccinos need to be sold. That's $2,000 rent payment divided by $4 contribution margin. Whereas 1,000 coffee puff pastries would need to be sold, $2,000 rent payment divided by $2 contribution margin to cover the same rent payment. For House of Coffee and their barista, that means twice as many pastries need to be sold versus the large cappuccino. This formula is quite an eye-opener. When they first came out with their coffee puff pastry, they had it everywhere, and by everywhere, we truly mean everywhere you can think of. Yet, it seemed like House of Coffee's numbers wouldn't quite live up to the effort put into promoting that new product. Knowing the unit contribution margin reveals to House of Coffee that they should focus their sales efforts on selling the large cappuccino. It's the product with the highest contribution margin, and therefore, fewer need to be sold to cover fixed costs and realize a profit. So, less baking and more brewing. In the next lesson, we'll find out how contribution margin can be expressed as a percentage of sales and why this is an important measure to calculate sales targets and reach profit target and goals as well.